If there is one thing that is not easily replaceable in our life, then it's our family. So it's our responsibility to ensure the financial protection of our family because life is always uncertain and people go into deep crisis when they least expect it. That's why it's wise to have yourself covered with a cushion that answers the question, what happens to my family if I'm not around? So, one of the most important aspects of our financial planning is to take life insurance so that in case of an unfortunate event, your dependents can continue live a dignified life. Today we are going to uncover what are the different types of term plans available in India and which one is right for you. Then what are the key riders you should consider to make your term plan more comprehensive? And how do you decide the right coverage amount and policy duration for your family's needs? So the feast is ready, it's time to serve. Now, when we talk about life insurance, there are many policies in India that promise a mix of insurance and investments. But I strongly recommend keeping your investments and life insurance separate. Why? Because these combined policies have higher premiums but lower coverage. And honestly, the returns are barely enough to make an impact. So the best option is to go for a term insurance plan, which is the purest form of life insurance. It gives you high coverage at a very affordable cost. But even within term plans, you have got three categories: regular term plan, return of premium plan, and zero cost term plan. Let me break down for you. Regular term plan. In this plan, if the insurer passes away during the policy term, their family receives a fixed sum assured. However, if the insurer survives the policy period, no amount is paid on maturity, and this is the most affordable options among three. Return of premium term plan. This plan ensures that the entire premium amount is returned if the insurer survives the policy term. But there's a catch. Though it offers a dual benefit, the premium for return of premium plan is nearly double that of regular term plans. And zero cost term plan. This is like the best of both worlds. You pay low premiums just like a regular term plan, and it has an exit feature where you can stop the plan at a specific stage and get your premiums back. For example, you start a zero cost term plan at 30, but by 60, you are financially secure. So if you want, you can exit the plan and get your premiums refunded. But remember, there's a minimum duration you need to pay premiums before exiting. So read the fine prints carefully. Next, I would like to discuss about the three key factors you should consider when choosing a term plan. First, claim settlement ratio. This ratio reflects the percentage of claims successfully settled by an insurer. A higher claim settlement ratio, typically above 95%, indicates that the insurer has a good track record of paying claims. Checking this ratio gives you confidence that the insurer will fulfill its promise when the time comes. Then, volume of complaints. While claim settlement ratio is crucial, it's also essential to check the volume of complaints lodged against the insurer. A lower number of complaints indicates better customer service and fewer disputes regarding claim settlements. Finally, amount settlement ratio. The amount settlement ratio is the total value of claims settled as a percentage of the total value of claims received. Some insurers may settle smaller claims while denying the larger ones to improve their claim settlement ratio. So it's important to review this ratio to ensure that higher value of claims are also being settled fairly. An amount settlement ratio above 90% is considered good and provides additional assurance regarding the insurer's reliability. Next, when opting for a term plan, you should consider adding these riders to enhance coverage and tailor the policy to your needs. Life stage benefit rider. This rider allows the insurer to increase the coverage during significant life events like marriage or birth of children. This ensures that the coverage grows with your changing financial responsibilities. Next, waiver of premium rider. If the insurer becomes seriously ill, disabled, or lost their ability to work, this rider ensures that the policy remains active without the need to pay premiums. This provides peace of mind during difficult times. Next, critical illness rider. This rider provides a lump sum payment in case the insurer is diagnosed with critical illnesses like cancer, stroke, or heart attack, etc. The amount paid is deducted from the sum assured but can help cover medical expenses and income loss during recovery. Finally, accidental death benefit rider. This provides an additional payout to the family if the insurer passes away due to an accident. It offers extra financial protection, especially in a country like India where accidental deaths are common. Now let me address some of the frequently asked questions. How much cover do I need in a term plan? The cover amount should ideally match your family's monthly expenses. For example, if your family requires 50,000 per month, your term plan should be sufficient to generate 50,000 from the interest of the sum assured. In this case, it's 1 crore. Also, you need to factor in inflation and any liabilities like home loan to determine a suitable cover. Next, what's the ideal duration for a term plan? Choose a term plan duration that covers your family's financial needs until they become self-sufficient. Most people opt for coverage till they turn 60 or 65, as by then they may have accumulated sufficient savings or retirement funds. Most importantly, should I opt for a separate term plan if I have employer provided coverage? Employer provided term plans may offer basic coverage but often lack essential features. Also, if you change jobs, the coverage may end. Having a separate term plan ensures continuous protection regardless of job switches. Finally, to wrap it up, term insurance is the most cost-effective way to protect your family with high coverage at low premiums. You can choose from regular term plans, return of premium plans, or zero-cost term plans based on your financial goals. Always consider the insurer's claim settlement ratio, volume of complaints, and amount settlement ratio before making a decision. Adding riders like life stage benefit, waiver of premium, critical illnesses, and accidental death benefit can enhance your policy's protection. Finally, ensure the coverage matches your needs and consider a separate plan if your employer's insurance isn't enough. And that's all for this video. But wait, did you know there are two ways to pay for your insurance: regular pay and limited pay. But choosing the right one could save you lakhs of rupees. So, which one would you choose? And that's the lead for my next video, so stay tuned. Until then, this is Sabarish signing off.